Imagine buying a business where spending money faster than your rivals is the only way to survive, but here is the catch. The moment you start making a profit, the system punishes you. For decades, owning a Formula One team was less of a business, and more of a highly coordinated multi-million-dollar corporate suicide pact. Look closely at a modern Formula One grid. You see 20 identical, pristine carbon fiber machines screaming down a straightaway at 200 miles an hour. You see drivers praised as heroes, flashing logos of global banks, tech conglomerates, and crypto exchanges. It looks like the absolute pinnacle of commercial success. But if you strip away the bodywork, pull back the telemetry screens, and audit the ledgers hidden in the back of the hospitality motorhomes, you discover something terrifying. For nearly 70 years, the business of Formula One did not make financial sense. It was a black hole that swallowed fortunes, ruined billionaires, and pushed historic engineering firms into sudden, quiet bankruptcies. Yet today, these exact same money-burning entities are experiencing a staggering economic transformation. Teams that were completely worthless a decade ago are suddenly being valued by Wall Street institutions at $1, $2, or even $3 billion. How does an industry that systematically destroys capital suddenly become one of the most fiercely defended asset classes on the planet? To understand the true economics of Formula One, you have to stop looking at the racetrack. You have to look at the ledger. And when you look closely, you realize that the most important race is not the one happening on the asphalt. It is the invisible, ruthless corporate autopsy happening behind closed doors. To the average viewer, a Formula One team operates like any normal sports franchise. You hire the best athletes, sell tickets, sign sponsors, and collect a share of the television broadcast revenue. In a standard business model, higher revenue naturally leads to higher profits. But Formula One operates on a completely inverted economic reality. Historically, every single dollar a team brought in was instantly incinerated in the pursuit of a tenth of a second on the track. If a team made $200 million in sponsorship, it spent $210 million on aerodynamics. If a rival spent $300 million, you had to spend $310 million just to keep up. It was a classic prisoner's dilemma. Winning required absolute financial ruin. To fix this structural madness, the sport introduced a revolutionary mechanism in recent years, a strict financial cost cap. Today, teams are legally restricted to spending around $135 million per season on performance. On paper, this was supposed to level the playing field, protect teams from themselves, and guarantee instant profitability for every owner on the grid. But here is the first major illusion. The cost cap is not actually a cap on what a team spends, it is merely a cap on what the public sees them spend. When you dive into the financial regulations, you find a massive list of exemptions that completely alters the math. The salaries of the drivers, completely excluded. The paychecks of the top 3 highest-paid executives, excluded. Marketing costs, corporate hospitality, travel logistics, and employee bonuses, all completely outside the cap. This creates a fascinating corporate paradox. While a team might officially report that it is adhering to the cost cap, its actual operational cash outflow can easily exceed $300 million a year. The cost cap did not stop the spending war, it simply forced corporate strategists to become masters of creative accounting. Think of it like a luxury restaurant. The cost cap limits how much the chef can spend on the raw ingredients for the steak. But it places absolutely no limit on the luxury decor of the dining room, the marketing campaign outside, or the salary of the celebrity chef greeting the guests. The wealthiest teams simply shifted their massive financial muscle into the areas the rulebook left unguarded. This brings us to the second layer of this economic machine, the brutal reality of the supply chain. In Formula One, there are 2 types of competitors. Works teams, who design and manufacture their own engines like Ferrari and Mercedes, and customer teams, who must purchase those engines like McLaren or Williams. An engine supply agreement is one of the most restrictive contracts in global sport. A customer team is legally capped at paying around €15 million a year for their power units. It sounds like a fair deal. But in reality, it traps the customer team in a state of permanent financial and technological dependency. When you buy an engine from a competitor, you are not just buying metal and pistons. You are buying their software, their cooling architecture, and their packaging constraints. The works team designs the engine to perfectly fit their car. The customer team receives the engine as a finished box and must design their entire aerodynamic concept around a shape they had no voice in creating. It is the equivalent of a smartphone manufacturer being forced to buy microchips from their direct retail rival. You might get the chip, but you will always receive it 3 months after they have already optimized their own software to run on it. The customer team pays millions for the privilege of running a race they are structurally designed to lose. Why then do new investors not simply bypass this trap by starting their own team from scratch? Why doesn't a tech giant like Apple or a state-backed automotive powerhouse simply build a factory and join the grid? Because the existing team owners have built an invisible, highly sophisticated regulatory wall to protect their territory. It is called the anti-dilution fee. Under the current commercial agreement that governs the sport, any new entrant wishing to join the Formula One grid must pay a flat, upfront penalty fee of $200 million. And here is the kicker: that money does not go to the sport's governing body. It is divided equally and paid directly into the bank accounts of the 10 existing teams. The economic logic behind this is fascinating. If an 11th team joins the sport, the total pool of television prize money must be split 11 ways instead of 10. Each existing team loses roughly 10% of their annual dividend. The $200 million fee is a calculated prepayment to compensate the incumbents for their lost future revenue. But as team valuations have skyrocketed, even $200 million is now considered far too cheap. The existing owners are actively lobbying to push this entry barrier to $600 million or more. They have effectively transformed a sporting competition into an ultra-exclusive cartel. To understand where the real profit hides in this cartel, you have to look at the secret document known as the Concord Agreement. This is the binding covenant between the teams and the commercial rights holder that dictates how billions of dollars in global broadcast revenue are distributed every single year. Most professional sports leagues distribute money based on current performance. The higher you finish in the standings, the more you earn. Formula One does this too, but with a highly controversial historical twist. Certain legacy teams receive massive, guaranteed financial bonuses simply for showing up. Ferrari, for example, possesses a unique historical standing clause that grants them a significant percentage of the entire prize pool before anyone else touches a single dollar. This means that even if a legacy team experiences a disastrous season and finishes near the bottom of the standings, their baseline revenue can remain higher than a mid-tier team that performed brilliantly on track. It is an economic safety net that completely insulates the sport's most powerful brands from the financial consequences of sporting failure. This structural asymmetry completely changes how corporate buyers evaluate these assets. In a traditional business, value is driven by cash flow, margins, and market share. In Formula One, value is driven by absolute government-sanctioned scarcity. There are only 20 seats on the grid. There are only 10 team franchises allowed to compete. You cannot simply buy a franchise license from the league office, you must convince one of the 10 existing owners to sell theirs. This turns a Formula One team into a classic Veblen good, a luxury asset where the demand increases as the price goes up, purely because it represents the ultimate status symbol for sovereign wealth funds, American private equity firms, and global billionaires. When Dorilton Capital purchased the struggling Williams team, or when Audi acquired a majority stake in Sauber, they were not buying the physical assets, the old factory buildings, or the wind tunnels. They were buying the irreplaceable entry ticket into a closed economic system. But this entire multi-billion-dollar structure faces a profound, looming vulnerability. The economic engine of Formula One has historically been powered by two massive revenue streams: global corporate sponsorships and highly lucrative race hosting fees paid by cities and governments around the world. To sustain these fees, the sports calendar has expanded to an exhausting 24 races a year, stretching across 5 continents. This hyper-expansion has pushed the operational supply chain to its absolute physical limit. The hidden cost of this growth is not measured in dollars but in human attrition. The specialized engineers, mechanics, and logistics experts who assemble these cars every single week are burning out at an unprecedented rate. Furthermore, as the sport pivots toward massive infrastructure investment from oil-rich nations and state-backed funds, it is decoupling itself from its traditional European fan base. If global economic conditions shift, or if international environmental regulations tighten around internal combustion entertainment, the massive corporate sponsors that currently underwrite these billion-dollar valuations could vanish just as quickly as they arrived. The ultimate lesson of Formula One economics is that it exposes the brilliant, dangerous power of manufactured scarcity. The sport successfully transformed a chronic, money-losing hobby for billionaires into a highly profitable corporate fortress. They did it by rewriting the laws of open competition and replacing them with a tightly controlled economic ecosystem where safety nets protect the elite and entry barriers lock out the rest. It is a stark reminder that in modern global capitalism, the most profitable businesses are rarely the ones that build the best product. They are the ones that successfully build the most expensive wall around the stadium.